Um, as many of you know that I've disappeared for a while because I'm on sabbatical.
Yeah.
Like all academics who are going to sabbatical, I had very ambitious plans at the beginning. Right? So my friend told me, who's also a mathematician, and he set out to solve the biggest mathematical problem in the world at the beginning. And after 3 months, he gave up. He said, I'm not going to solve any of these problems. He decided to go hiking and yoga every day. And so at this beginning of the summer, I also started to think maybe, so I've done research for 15 years, almost 15 years since the beginning of my PhD, and my research were more or less narrowly focused on particular problems, on risk theory, accident insurance, and I published a lot of papers. But then I started to think that maybe I lost sight of the forest for the trees. So I wanted to look at the big picture, what's going on in the industry. So I started sort of this a scavenger hunt at the beginning. So I wanted to know, where are the big problems. I started to look at a lot of papers, and it didn't go very far. And then I start to think maybe if it's really going to be a big problem, and I've read a lot of the insurance literature, should have already know about it. So I start to think maybe I should just look around and what's happening around us. And one of the buzzwords in the insurance industry these days is insurtech, right? And like many other industries, there is a trend of moving to digitalization, right? On the surface, everything is about digitalization, moving everything online. But deep down at the core of these business models, there seems to be a trend for decentralization and disintermediation. So for example, in the media industry, we used to read books. Right? If I wanted to know a new concept, I look up a dictionary or go to some encyclopedia. But that's no longer the case. You look, maybe one of the first things I usually do is just Google it and look it up on Wikipedia. And so that's actually a decentralized system where there is no authority to decide what you can contribute to the system. Actually, everybody can change the definition of a concept. The system is self-regulated, it's self-corrected. If there's something wrong, someone else will correct it for you. So we all together maintain this body of knowledge on the platform. So it's a decentralized system. And if you look at the currency, right? So the currency are maintained by central government, national government. It's affected by fiscal policy, but there's the invention of Bitcoin that's not really controlled by any national government. That's totally independent of fiscal policies. And this is also happening in other fields. I just gave you a small sample of what's happening. Like for example, if you want to make your opinion public, you don't have to. Nowadays, you write an article, right? So send it to newspaper, and hopefully someone will decide, the editor will decide you will be able to publish. But these days, you can just do what President Trump does, right? You can go to Twitter and send out a Twitter storm every morning, and you can make your words heard. And this is going on. You can give a lot of examples like this, and of course, this is happening not just in the media; it's also happening almost in every single industry, right? The transportation, service industry, and product sharing. And there's a lot of examples, and this is a very nice graph made by this company that I see the other day. And this is only a small sample of the startups in the sharing economy space. And if you're a venture capitalist, right? You look for opportunities to invest, especially angel capitalists. You will see that the sharing economy, this market is actually very competitive these days, and most of the concept business models developed on the internet about product sharing, right? You use the goods, and if you're not using that, let someone else just use it. Shared cars, shared bikes, and transportation tools, and there's a lot of shared services, right? You can let someone do the labor work for you. You can just go online, find someone to wait in a line for you. There's a lot of different innovation in this area. So this is already very competitive market. I challenge you to think of anything that can be shared that's not already being shared on the internet. I think the next wave, in my opinion, the next wave of innovation will be in the space of risk sharing, and this is actually what I'm going to talk about today. So how do you trade your uncertainty, your risk, with others? And this is already happening in the insurance space. For example, when you go to buy an insurance contract, right, you actually paying a premium for the insurer to buy your uncertainty, right? So this is actually doing risk sharing with insurance. But what I'm talking about today is how do you trade uncertainty with each other without the traditional role of an insurer? And this is also about this decentralization. So there are a lot of innovations in the insurance industry at the moment, and I wanted to give you sort of a bigger picture. And here's sort of the relationship of the sum of the technology development industry. And what I'm talking about today is actually a very small piece of everything of this big movement in the industry, right? For example, blockchain. This is sort of a new technology for storing, sharing data on the internet. And there's some application in the insurance industry about smart contract, right? Because the data can be distributed on public ledgers, it's very hard to tamper the data. And so there is the application to use the system to automate insurance claims to prevent fraudulence, to actually improve the efficiency of services. For example, if all the data can be shared on a blockchain, like you could have an life insurance contract that can pay claims automatically when this death benefit. So let's say life contract, you would make death benefit when someone dies, policyholder dies, right? If the death certificate is stored on a blockchain system, then whenever this death certificate is uploaded in the system, then it will trigger a payment automatically using this digitalized contract. So there's a lot of applications like this. But what I'm talking about today is actually in the space of this peer-to-peer insurance. It's a small piece of everything going on. And I like this topic particularly because this has sort of a design engineering structure into this, and I will explain what I meant in a few minutes. Okay, so in simple words, what is a peer-to-peer insurance? That's actually a very, it sounds new, but it's actually a very, very old concept, right? It's a network of participants pulling resources together to compensate for each other's losses. And this concept was actually developed in almost all ancient civilizations. You can find ancient records of the Chinese, Babylonians, Greeks. They all have some sort of mutual support, solidarity groups in the ancient history. And that's actually it predates the modern insurance industry. So for example, if you're a religious group, you could get together, each contribute some amount to a common fund, and you use the fund to pay for the members who suffer losses. And that's a very ancient concept. And the reason that it has been revived these days is because many people argue that this is the way to bring trust back to the insurance. Right? So in the insurance industry at the moment, there seems to be a problem with the mutual trust. There's a very common perception that insurer will do everything to deny a claim, and then the insurers believe the policyholders will always want to do fake claims, right? Try to take advantage of their assistance. So if you develop sort of a peer-to-peer system, then you sort of watch out for each other. The chance of having for example, if you have a small group of your family and friends providing insurance to each other, then you're sort of under this peer pressure not to sort of fake claims, right? Because you sort of know each other, you watch out for each other. It has a very simple pricing structure, right? Because when there's a claim, the cost is distributed. Well, if we're talking about the very short period general insurance, let's say auto claims, then the cost is typically equally shared among all the participants, right? So you don't have to worry about, like in traditional insurance, many people believe that insurance products are overpriced, right? Because you have to pay for this very luxury office building. You pay this very high executive pays, and you worry about this administrative cost. But this would be non-existent for a peer-to-peer system, because everything is facilitated by someone, it's sort of a facilitator who doesn't really necessarily know anything about insurance, right? So it's a very transparent. You know what you're paying to each other. And there's also reduction in regulatory costs because, for example, in China, which I will talk about today, the mutual aid, this new form of P2P insurance, is unregulated at the moment, right? And because it actually try to distance themselves from the traditional insurance, so they're not under the stringent regulatory requirements for traditional insurance. So they don't have to put aside reserves. They don't have to put aside risk capitals because they're not really guarantee anything. So the cost of the regulatory regulation is actually lowered. And some people even argue that this removal of insurer will help to become more responsive to customer needs, because there are certain types of risks that are now traditionally covered by insurer. Right? For example, if you're a minor, a particular high risk group, traditional insurer would not really cover you because it's very hard to make any profit. So, but if you form your own mutual support group and you trade risk with each other, then you will be able to cover each other's needs. I tried Control L, didn't work. It's getting me out. Okay. All right. So, and there's a lot of interest in this industry at the moment. You can see that this is the global InsurTech funding at the moment. And if you look at the funding for this year, the first 2 quarters, the funding almost double the size of funding of the same period last year. So there's a lot of great interest in this area. And that's the right side. I showed this the top 4 deals for the InsurTech funding over the 2nd quarter this year. And 2 of these 5, Lemonade is the P2P insurance in the US market, and this one, the Suidihu's Waterdrop Mutual Aid. This company is actually the 2nd largest mutual aid platform in China. They actually are the big players, and you can see that these 4 companies, the 4 deals actually make up about 60% of the InsurTech funding at the moment. So there's great interest in this area at the moment, especially on P2P insurance. Okay, so the P2P insurance actually takes different forms in different markets at the moment. So in the West, it actually started with this startup in Germany in 2010. It was a company called Fragrance, and they started the world's first the P2P insurance model, which I will talk about in a few minutes. And the largest player in the US market is the Lemonade, providing renters insurance. And it's very interesting that in the Middle East, the Islamic world, they have their own version of this called Takaful, and this has been around for decades. Okay, but it's very similar to the Western version of P2P insurance. And I will also point out that this P2P insurance also has a sort of a takes different form in China. They call that online mutual aid. It's got slightly different structure, and I will go over each of these different models. So this is the world's first P2P insurance, started in Germany. The model is very simple. So they let you form your own support groups, right? Typically with 9 people involved. So you would find 9 of your friends or family members, all know each other. You form groups, and then you would each contribute some amount to this common fund, and the Fragrance, this platform plays the role of an insurance broker. So they would have you buy. They would actually give you a list of insurance policies from other companies. Okay, so a portion of your contribution will go to buy insurance, and the remainder will be used in this common fund. So when there is a small claim, it will go into the common fund. But if there's a big claim, right, if it's more than the capacity of your common fund, it will be paid by the insurer. That's actually the very simple model. This is called broker model. And if the claim, if there's any remaining amount at the end of the year, then you will be refunded. You will be refunded for that. So that's a very simple model. So the most successful model in the US is Lemonade, right? And you just simply download this app, and then I can give you a quote very quickly, right? You can get insurance for 90 seconds. You don't even need the traditional underwriting procedure. And they got a very simple model. They charge a flat administrative fee. 20% of your payment will go to administrative cost, and then 80% will go into this common fund. Again, but this time in the US, they use a carrier model, meaning that the Lemonade will act as the insurer. Okay, if this common fund does not have sufficient funding, Lemonade will pay your expenses. So it's got slight deviation from the Fragrance model. If there's any remaining amount in the fund at the end of the year, the money will go to a charitable organization of your choosing. Okay. And usually it's very small cost, right? Just less than $10 a month. So it's quite a very attractive model. So they always argue that they overcome all these problems with the insurance industry. If you go watch their founders, this online promotions videos, it just gets you very excited about how good this is. And the thing that the technology we introduced, they use this artificial intelligence to have this chatbot. So if you download the app, you would actually have a conversation with this chatbot. They collect the information through conversations, and then the other fancy things is when you submit claims or even submit applications, you don't really deal with any real person. Right? The machine learning algorithm will work to get you through the process. They actually broke a Guinness record by making the claim in less than 3 minutes. 3 minutes, right? From the moment you submit a claim to the moment you get paid. It's less than 3 minutes. This is a great sort of innovation in the market. But I actually honestly find this part very boring because it doesn't have anything to do with the actual models. Right? The model is actually very simple. It's just that they're using very fancy marketing techniques. But I will show you the kind of math models we can do with this kind of business model. So in the Mid East, they have this very well-established system called Takaful. I believe Takaful is the Arabic word for solidarity. Okay, and it is compliant with the Sharia law, right? And it's very interesting to learn about the Islamic finance. And they almost got a sort of their own version of everything in the Western world, just like the Chinese, but they have different innovations. So they believe that in the Sharia law, they don't really allow because in the Western model, the conventional insurance model, there's sort of uncertainty involved with the payment. Like if you, for example, in life insurance, if you die early, if you die early, essentially you don't have to make a payment. You use someone else's premium to cover subsidize the payment to you. So there's the term insurance I'm talking about. If you don't die, then your money essentially is confiscated, right? So this is sort of in the Islamic law. This is kind of like a gambling. So they don't allow that. So they have this own version where people contribute to this tabura fund. Tabura is the Arabic word for contribution, and you have this common fund. And when there's a claim, it will be first paid out of this common fund. And what is different in the system is that if there's not a sufficient, there will be a facilitator, there will be a technical administrator, and this is backed by some sort of financial groups. If there isn't sufficient funding in this fund, then this financial group behind this backing this fund will actually pay that, and if there's a surplus, the surplus will go to the administrator. So we've got a slightly different model. So now let's look at the Far East. In China, this is very interesting. It's got a slightly different flavor now. They don't really call this P2P insurance. I think part of the reason is that there was a huge development of P2P lending in the banking industry, and because there was so much fraudulence in the market, right, it kind of got into this Ponzi scheme. A lot of companies just borrow money and then run away. So it got really bad reputation. So anytime you mention P2P, it's a big taboo in Chinese market at the moment. So they don't really use that. They use mutual aid. Majority of the mutual aid platforms in China, they focus on healthcare. I think this is probably because of the Chinese the government has the equivalent of a social security, but it doesn't cover they pay a very small amount of your healthcare cost if you have a major critical illness. Right? It's not sufficient, and commercial health industry is not very well developed in China at the moment. People think the healthcare insurance is way too expensive, and most of the players in the market are sort of the state-owned enterprises. They really, it's not that competitive market, so they have a monopoly sort of condition at the moment. So this creates a vacuum for new players, and it turns out that the regulators are very conservative. They don't want to give out insurance licenses at the moment, right? There's only like over 100 insurers in China, right, including property and casualty insurance, life insurance. But if you think about Hong Kong, just the city alone, they have more than 150 insurers. So this is how tight this is regulated. So there's like a backlog of over 300 applications, but they don't want to approve any more insurance companies in the moment. So a lot of the companies, they want to get into markets by doing something similar to insurance, but they try to distance themselves from insurance. They say this is not insurance, this is mutual aid. But they're doing something very similar to insurance, as you can imagine. The innovation in this market, there's no funding pool, so you don't really contribute anything into the system. Okay, you make no payment. You can enter the mutual aid agreement with no payment at all. But when there's a claim, the cost of the claim will be split among all the participants. So there's payment in arrears. And even though you think that this is not so much different from the payment in advance, right? But then this is a huge psychological effect. Right? People somehow, when they enter this, they think they got free lunch, and they don't have to pay anything. They get coverage, and when they pay, they pay a very small amount, like say for a coverage of 300,000, you pay just $1 when you have 300 million people splitting costs. So it's very attractive. So there's a very dramatic growth in the market at the moment. For example, this is the data I collected for this year. Beginning of this year, right? For example, this company of Xiangpubao, and this is backed by the e-commerce giant Alibaba, right? Ant Financial. So they entered this market just last year, summer last year, 2018, and less than 1 month, I think less than 1 month, they grew over a million, and then quickly got the attention of the insurance regulator. And initially they called this insurance, but then for those who speak Chinese, the Bao used to means insurance, 保险. But then the regulator said you cannot do this, you go too fast, and you're not supposed to be called insurance. They changed to 宝贝. The different the play with words, so that it's not considered insurance anymore. And baby, I think it means baby. No, treasure instead of insurance. So they grow so fast in less than half a year, and now it grows to 86 million. So over this year, there's exponential growth, right? Actually, going from less than 20 at the beginning of the year to 86. And the whole market grows so much that now it's reached almost 260 million, which is about 25%. 1 in every 4 Chinese actually were covered by some sort of mutual aid platform. And in less than, this industry started just only 3 years ago. So this is crazy. Right? It's never unprecedented in any industry in the market. So this is causing a lot of anxiety in the insurance industry at the moment. Right? So they're seeing competitions from these platforms, but then they are saying, well, we're not insurance, so don't regulate us. And so they're sort of getting this gray area at the moment. And certainly this is very interesting to see how it's going to play out. So at the moment, they don't do any reserving, any sort of traditional insurance requirement. And the Chinese government is really, don't really have any sort of any regulation at the moment. Nobody want to touch this because nobody want to take the responsibility, right? If something go wrong at the moment. So they are sort of self-regulated at the moment. There are 2 types of models that are the most successful in the Chinese market at the moment. The one type of platforms, they have the financial backing of the largest tech firms, right? Like Alibaba, Tencent. And these companies, they don't have insurance license. Again, they want to enter this market by going into this insurance-like business. And Didi is the Chinese equivalent of Uber. Right? So they usually doing this mutual aid platform for the drivers and passengers, and so they're getting very successful. The other type is the business that started as a crowdfunding platform, like 水滴互助, the one that I showed you earlier in the top 4 deals. They started as a crowdfunding platform, so 水滴筹, and then they got and they have an interesting model. So basically, people who go into this crowdfunding model, they are, because they see the family tragedies, right? And then they are more educated about the healthcare risks, and they are more informed about the risks. So they are more likely to be converted to this mutual aid platforms. Okay, and most of the original platforms, the smaller ones actually didn't quite survive. So this is very. Okay. All right. Okay, so quick review. So if you look at the structure of this product, the business models, essentially these are based on traditional mutual insurance model, right? These are self-managed pooled funds. So all these participants contribute to common fund and will pay out of this common fund. And as you get to the standardized modern insurance, there's the sort of the intermediate insurer. So basically, you're having a contract between the policyholder and insurer. The insurer will take all the counterparty risk, right? Even if there's not enough premium, not enough funding to cover all the expenses, they will still have beyond the contract obligation to pay. So they are taking on counterparty risks, and then that's why they're heavily regulated, right? You have to put aside reserves and risk capital to absorb unexpected losses. Okay? But then this is very useful in the modern society because it's all become standardized, right? You no longer rely on particular religion or a particular professional organization to organize mutual aid. But now with the innovation of internet type knowledge, there's a comeback of this mutual aid. But now we've got a slightly different structure, it's a network structure, right? So, but I have to warn you, right? This is not exactly what's happening in the market at the moment. Right? It's sort of got the original star structure at the moment. So what the mathematical model I'm presenting today is more of a network structure. So I'm trying to say that this is quite a, so what our research work is actually an improvement of the existing business models in the market. And the advantage of this apparently is the removal of the insurers and lower down the intermediation cost and regulation cost. Okay, so this is what's going on. This is sort of the movement of the decentralization in the insurance market. There's a similar movement in the annuity market as well, right? But I don't have to talk about it today. But there's a movement from annuity to something called Tom-Ting, which is essentially a decentralized system of annuity as well. And my PhD student Mao actually is an expert on this now. So what I'm presenting today is essentially improvement. So if you look at the classical models in insurance, they are usually a coverage of a single type of insurance, single type of risk, right? If you buy life insurance, it's all about mortality risk, longevity risks, right? But the model we're presenting today would allow you to cover different types of risks. Right? If I have sort of let's say I want to buy renter's insurance, right? And then I can go into this pool, get a coverage, but someone else may have a different need. I want to cover my, get paid for a cracked screen for my cell phone. You can also do that. But this is a very idealized model. This doesn't exist in market at the moment, so I'm trying to promote this. I don't know if anybody would invest in this, but theoretically this is going to be possible. Okay, I'm going to show you how to do that. Okay, so there are two types of models. There's one pooled funding model and the other is mutual aid. I'm going to show you mathematical models for both of them. Okay, so let's look at, let's first look at the mutual aid. So in the market at the moment, there are two types of methods. So there's like all insurance, there's the problem with adverse selection, right? If I'm a 60-year-old, right, entering the platform with a what did it say? It's a 60-year-old, then enter the market with a 20-year-old, then the 10 to 20-year-old may be worried, right? If we're going to pay the same, right, the likelihood of I getting a payment is much higher than him getting a payment. So there's sort of fairness issue. So the way they address this issue in the market at the moment is to break it down into age groups. Okay, so two types of methods. One is equal cost sharing but different benefits. So this is the case for a platform called Zhongtuobang. So I think this is the age group from 0 to 25, 26, 66, 1 to plus. And you see that the cost sharing for this, for example, you see this age group, cost for this group is actually twice that for this group, and this is twice that group. This is not coincidence. They use some sort of a cost sharing coefficient. So this is 1, 2, and 3. Okay, if you're in this group, we're going to count 2 shares, and you're going to pay 2 shares, and this is 1 share. Okay, so there's some sort of this is essentially the idea for differential pricing, which is very standard for insurance, for the traditional insurance. Right? When you buy insurance, you always look at this table, the premium table for different ages, be paid differently. So they're trying to borrow the same idea from insurance. But the question is how do the first thing I thought about, why is it 1, 2, and 3? I try to figure out, is this really accurate? Even if it's 1, 2, 3, and for the age between 26 and 50, apparently, right? So I'm using, because I'm paying the same cost sharing, so actually the 6-year-old is, a 26-year-old is actually, the money is used to subsidize the 50-year-old. So I'm trying to figure out exactly how to do this. So that's how I got into this research problem. And I actually don't know how the practitioner is doing this at the moment, but I'm trying to build a model to explain how you can do this more accurately. Okay, so let's see the model I have. So I'm going to do this way. Suppose each claimant receives a monetary unit, let's say $1. Okay, I'm going to introduce an indicator of the J's participant survival over a particular period. Okay, so if they survive, they don't pay. You don't get paid, right? Only if you suffer loss, you will be paid 300,000, for example. Okay, and then I'm going to use notation PJ is the probability of survival, QJ is probability of loss. Okay, and then I'm going to introduce a cost sharing coefficient. WJ is a coefficient. Right? This company just used 1, 2, and 3. I'm trying to verify if this is actually correct. Okay, so this will be the 1, 2, 3. Okay, now I'm assuming all the participants are the future life. The loss probability are independent of each other. Okay, so now let's think about the J's person's benefit if he or she suffers a loss. Okay, so the person will always receive a benefit as long as at least one participant other than himself survives, right? Because someone else will carry the cost for you, right? But you have to consider the special case where everybody have a claim, so then nobody's there to pay for anybody or anybody else, right? Let's have to exclude that case. So mathematically, this is represented in this way, okay? So this product there is to exclude that case. Essentially, if everybody suffer loss, and this product will be 1. Right? If at least one of them is still alive, still survive, then this product will be 0. So you get paid $1, right? Okay. And then this is the cost. As I said, I'm assuming the benefit is actually $1. Right? So now I'm going to distribute this cost among all the survivors. Right? Among all the survivors. Okay. So then, what you do is you would look at, so the numerator, the denominator is the number of shares, right? So I use myself. So if I'm the J's person, because this is our relative, right? So if someone paid the coefficient is twice mine, then they're paying 2 shares. And if you use my unit as 1 share, so divide both sides by WG, you will see that this is my share and this is other people's share, right? Okay, and then that's if the person survives, they will pay their share, right? Okay, and then this is exactly how much you pay for each share, and then of course I will multiply this by my share WJ. That's how much I would pay. Okay, all right. So this is what I would pay. And then I'm going to use this very classic, the actuarial equivalence principle. On one hand, I have expected value of what I would pay. On the other hand, I have expected value of what I get. Okay. So with probability QJ, that's probability of loss, I will get my $1 essentially, except the case that everybody else suffers loss. So this right hand side is expected value of my income, and left hand side is expected value of my outgo. Yes. Very classical actuarial principle applied to mutual aid. Okay, and it is very interesting that one can show that in general you cannot find such a W that this equation holds, except for the case where all the W's are the same, or the QJs are the same, homogeneous group. Everybody is 50-year-old. Everybody will pay equal amount to the system. Then you can have this. Then you would have this equivalence principle. whole. And the proof for that is actually very elementary. Any calculus student can do this, right? So if you look at the expression I gave you earlier, if the pj's are the same, then you can combine that. The sum of the ij is essentially each ij is a Bernoulli random variable. The sum of each ij would be a binomial random variable. So you have this expression, and if you just simply plug in the probability density function for the binomial random variable, you can quickly work out the calculus. Then you would work out the right hand side exactly this. This would match, okay? But if it's not the same, I mean, we've tried. Okay, we have not proven it exactly. This is mostly more of a conjecture, but we've shown that it tested. At least we can do that for when n equals 3. This is even when n equals 2, only when p equals j, this will hold. So we have yet to give a full proof for this for the general n, but I suspect there's no way you can do this. So I don't really know how they come up with this 1, 2, 3. There's no rigorous scientific foundation for doing that. So I've been thinking, oh, if this is not possible to do that, how are you going to do? So that means if you're going to use a one-dimensional cost-sharing coefficient, there's no way you can do this in a fair way for all the participants. Okay, and what should happen, we realize, is that it has to be two-dimensional. What I meant is that at the moment, this coefficient depends on your age, right? The donor's age. You would have to devise a system that allocate the cost that consider both my age and then the recipient's age. Okay, make it two-dimensional, then you can actually make it work. Okay. Okay, let me introduce this two-dimensional allocation system. So now I'm looking at example. So what I gave you earlier is the mutual aid model where there's no common pool, there's payments are made in arrears. Now, for simplicity, right? I don't have time to cover all that. So for simplicity, let's look at the peer-to-peer insurance, the Western version of this. So this is where everybody contributes to the system and the claims be made out of the common fund. Okay, this I can show easily in a few minutes. Okay, so again, I consider a system with n individuals with different risks, meaning that this is an inhomogeneous group. Okay, and this is a short-term insurance, interest is 0. Okay, if this person survives, then they would have beyond the obligation to pay for others. So there will be transfer of cash from his account to someone else's account. Okay, so there's essentially a redistribution of wealth, but I want to do so in an actuarial fair way, meaning that expected income should match the expected outgo. Okay, so that's my goal. So how do I do this? Okay, so again, the same notation, PI denotes probability of probability of survivorship. I survive without any loss. So now I'm going to introduce this two-dimensional cost-sharing coefficient, the alpha ij. So alpha ij, so now it depends both on the donor and the recipient, the risk profile, right? Okay, so now the alpha ij represents the proportion of the ith wealth, ith deposit transferred to the jth individual's account. Okay, okay. All right. So then you look at left hand side. This is exactly the outcome. So if the first person survives with probability pi, his money will be transferred. Right? This proportion will be transferred to the ith individual's account. Right. Second individual, if she survives, then this portion will be transferred. So you do this for everybody. Okay, so this is the average amount I get from everybody else, including myself. Right? On the right hand side is what I would pay to others. Okay, if I survive, I will give away my $1. Of course, this includes the alpha j ii, which is the amount to retain by myself. If we try the alpha j, it means if you force it to 0, then the system may not have a solution. So that's why we let it be non-zero. Okay, so this is if you do this, right, then you want to do have the condition that these coefficients are between 0 and 1, right? And the row sum has to be 1 because $1 has to go somewhere, right? Okay. So then you want to solve this, but then you got a problem here because you have n squared coefficients. You only had n equations, linear equations. Well, there's other n equations here, but there's only 2 n equations with a bunch of inequalities. So the system we have infinite many solutions. But it's very interesting. This equation, if you look very carefully, first of all, I mean, this is a scale invariant, right? So if you divide both sides by any non-zero constant, this would still hold. So I can normalize this by, first you remember, right? These are the probability of loss, probability of survivalship, so they may not add up to 1. Right? Everybody comes in with a different risk. My probability risk of surviving fire plus your probability of surviving a car crash, it may not add up to 1. It'll actually be greater than 1, hopefully. So then the sum, so now I can normalize by dividing the sum of p, so then this becomes the probability of this probability mass function of some random variable, right? And then you look at this carefully, write it in matrix form. This is PA, A is this transfer ratio matrix equals P. And then you quickly realize this is what we learned in probability, right? It looks like if A is the transition probability matrix of some Markov chain, and P is the stationary distribution, then this equation would hold, right? But in probability, you got the opposite problem. You typically know the transition probability and you solve for the stationary distribution. But now, in this case, the P is known. Right, so this is probability of survivalship, and then I solve for A, the transition probability. So we tried to look for probability literature, but we didn't find anything. So we have to come up with our own solution. And of course, there are some trivial cases. I think I'm running out of time, so I will just point out one case. If I have an algorithm that's donor invariant, donor indifferent, meaning that I don't really care about who pays, I only care about who receives, then alpha I equals alpha j, then this equation will become, you can solve that very elementary result. So the ratio you should pay is the probability of survivalship divided by the sum of survivalship. So going back to that example, that you have these groups. If you have, you remember this group? So I think the fair way to do this is that you look at the 26-year-old probability of survival, and you look at the sum of everybody's probability of survival, and that ratio is actually the fair way, not in this 1, 2, 3. So this is one solution, but this is not the only solution. So then we went on to use some minimization. So then we come up with an algorithm that has the minimal fluctuation of the cost, right? Because in this system is a redistribution of wealth. So depending on how many people make claims, you share the cost to be shared is different for different cases, right? So then, because you're paying different amounts, so I'm trying to find a way that minimizes the fluctuation of the cost. Does that make sense? Yeah. Then you have, of course, everybody got different costs, and you're sort of looking some sort of a Pareto optimality. You look at the average of these variances. Then this goes back to this. It's kind of like a classical portfolio optimization problem. Where you have certain objective goal, mean variance goal, and then you try to solve the alpha so that this is minimized under the constraint that this has to be fair for everybody involved. Okay, and in very nice cases, you can actually find solutions, analytical solutions. If there's only 2, then most of the cases you can find analytical solutions. But for the high-dimensional case, you have to use some numerical algorithm to do that. But there's a way to do this. And then we went on to develop different types of models, and depending on who's paying what and how much is paying. and there's great variety, and we can also find sort of the mutual aid models as well. So there's a lot of very interesting models that one can play with that can develop different strategies. I think this is going to be very useful for the industry practice, right? If they really serious about fairness for everybody involved. And I have this unrealistic, maybe it's not unrealistic at the moment. I was hoping that one day, we would move into a model where people actually can really exchange different risks, right? Because I have different needs for coverage. Then I think this would kind of provide some sort of a theoretical foundation for developing such a system in the future where people actually trade different types of risk. I think this will be very helpful, especially for people who don't get coverage, like very old people, and nobody wanted to sell insurance for them. For example, the platform I've just shown you, the maximum age is 65. If you are older than that, you don't get anything at all. So hopefully, with a system like this, you would be able to trade your risk with others, and because you can trade different risks, you can actually take advantage of all large number. Even people in your age group is very small, but then because you're trading with people in different age group with different types of risk, you can actually share the risk with a much larger risk pool. Okay, so that's all for my talk. Thank you very much for your attention. Any questions are welcome.
So what are the other, for example, you guys you're doing this research. Are there other people, other groups also doing similar research, or any other people doing similar research or similar spirit?
So we did a review. Nobody else in the industry is doing something like this. I think the industry is very interested in this. I've never seen any paper that put it into mathematical formulation.
So what you're trying to do, you're trying to put some of the things into some firmer background, ground, so they want to give some theoretical basis to it.
Yes.
Even in the industry, they don't have their own research going on.
They do.
But maybe they don't publicize.
Well, so I actually visited a bunch of them. The response I get, either some of them don't really care about like the equal fairness. So one company told me it said there's no technology insurance, forget about it. We're trying to get away from insurance. Now you're just bringing back all this insurance stuff. So some of them don't even like this idea. The other ones, they said it's too complicated. There's high cost for education. If you do this, people don't understand it. They don't buy this stuff. So let's make it simple. Everybody pay the same. Let's restrict it who can participate. That's easier. So that's kind of the response I have.
I didn't understand. How do the mutual aid companies make their money?
Oh, so they charge an administrative fee. Yes. So like the Lemonade, they charge like the flat 20%. Yeah, the 80% goes to.
No, the mutual aid, the ones in China.
They also charge a fee.
Oh.
Yeah, between 8%, 10%. So you enter the mutual aid plan?
No. I was like the cash flow is huge, so we actually can make a lot of management fee.
Right. So, but many of them told me that they don't really make a lot of money at the moment. What they really intend to do is to become insurer eventually. So this is a way of educating people about insurance. It's sort of some intermediate step. They are playing a long-term game. Yes.
I really like the idea of sharing different risks, but I wonder what's the advantage of sharing different risks, because you can always find people want to share the same risk. So,
yes.
But why you want to share the different?
Yeah, so actually, this is one response I get from one of the insurers as well. They said basically we don't care about different risks. I got China's huge population. I got even for a tiny type of risk, I got huge population covered. So I don't really care about this. What I think it would be useful is for the group to the marginalized group that cannot get insurance, so they can do the form their own mutual aid group. But then, for this to be cost effective, you have to to have this law of large number, right? You have to get a huge group, but then doing this, you can trade with other groups, and you don't need a big number to start with.
Okay, if there are no more questions, let's thank you.
Okay, thank you.